Okay, over here I'm just simplifying the calculation for this year's depreciation. I will take at the beginning of the year cost times by 20%. So the depreciation for this year will be 18,000. That is because the purchase and sold occurred at the end of the year. So this cost 90,000 will include the machine that was sold, the delivery vehicle that was sold at the end of the year. So, and it does not include the one that was purchased at the end of the year. So that means I'm taking the beginning of the year cost times 20%. Some of you may say that, oh, this is not very accurate because the net book value of the vehicle sold is 7,000. And then the cost, if you exclude the one that was sold, will be 50,000 times 20%, so it's 10,000 plus the 7,000 for the vehicle, so it should be 7,000. I'm not doing a very detailed calculation. I'm just doing an overall calculation, taking the beginning of the year cost times 20% to simplify this detailed calculation. If you want to make it very accurate, you can calculate it at 17,000, and then in the profit and loss account you put 17,000, and the accumulated depreciation you put 17,000, which is also correct. So but I'm just simplifying the calculation and putting it 90,000 times 20%. Okay, you see in the question it says that the new delivery vehicle cost 70,000, and 58,000 the invoice is awaiting from the supplier. That 58,000 is unpaid. So the 12,000 was not paid by way of cash. It was paid by way of taking in the old vehicle. So that means the old vehicle, which the net book value is 0, was traded in, and the supplier give us the trade-in value for the old vehicle as 12,000. Okay, so that means the gain on sale of this motor vehicle would be 12,000, and 12,000 will be included as other income, gain on sale of delivery vehicle. So you realize that we have actually um, put in all the figures. Okay, so how about this provision for depreciation? Provision for depreciation, you will take the provision for depreciation at the beginning of the year, which is stated in the question. So for example, provision for depreciation for factory plant of equipment, which is 124,000. 124,000, take your calculator, 124. Then you add depreciation of factory plant and equipment during the year plus 42. So you will get 166,000. So similarly with other plant and equipment, you take the one in the profit in the question, which is 35,000. Then you add the depreciation for the year 9, so you get 44,000. So delivery vehicle, same thing. The one at the beginning, the one charged for the year is 18. Delivery vehicle, actually we have done our calculation here already. Beginning of the year minus the one sold plus the depreciation for the year, so it's 42,000. So it's 42,000, and the freehold property, so 1,000 is in the profit and loss account. Then in the manufacturing account we actually charge 4,000 for the factory building depreciation. Then you add the depreciation for factory freehold property uh, at the beginning of the year plus 30, so it's 35. So it's 35. So that's how you get 35. So cost minus provision for depreciation, you will get all the net book value. Then you total this. So in the manufacturing account, it's also settled. We got all the figures. Okay, this is cost of production. The cost of production for the factory. Then you add the 20% notional manufacturing profit. That means internal manufacturing profit. And then this will be the cost transferred to the warehouse. So transferred to the warehouse, so you put in the trading account, manufacturing cost transferred to the warehouse. So this is inclusive of the 20% profit, internal profit element. So you add up, then you get this one. So this is the trading profit. You see this one, net sales minus the cost of sales, which include the 20% manufacturing profit. So this is the trading profit. The profit that is generated by the trading section of the company. And then you see this one is inclusive of the manufacturing profit. So when this one is inclusive, it will actually, so the cost of goods sold would have include the 20% manufacturing profit, which is 163,000. That's why the trading profit is the sales minus the cost of sales. The trading profit excludes the manufacturing profit. Okay, exclude this manufacturing profit. So that means if you want to find the actual total profit for the company is 372,000, because if you want to find the actual total profit for the company, you should have used the cost of production, which is lower. If you use this figure, then your gross profit for the company would have been 372,000. But we are so called we include the notional manufacturing profits here so that we can get a trading profit figure and a manufacturing profit figure, and this is the total profit for the company. Okay, so that here we have nicely divided. This is the trading profit that is that should be credited to the trading department of the company, and this is the manufacturing profit, which should be credited to the factory department of the company, and the total gross profit is 372,000 plus gain on sale or delivery vehicle. So this is the amount, then less all your expenses, then you get your net profit, which is 253,000. Okay, so if you look at the question, the profit and loss account at 1 October 2003 is 130,000. 130 plus 253, which is this year's profit, will be 383,000. 383,000. So okay, you see this is the retained profit at 1 October 2003. And this is net profit for the year, which is from the profit and loss account. Okay, and then the total retained profit at the end of the year is 383,000. So this is the total shareholders' funds. So we have obtained all the figure. Then come to part C. State 2 reasons why a company may wish to transfer its finished goods from the factory to warehouse at a price exceeding the factory cost of production. So I have explained in very lengthy detail just now. So in written form, I would say to give some credit to the factory workforce, which would help determine promotion and bonus payment. So I'm just putting my thoughts in papers. To charge the warehouse at an amount comparable to goods that are sold in the open market. To know at any point of time it is more worthwhile, if it is more worthwhile to manufacture or to purchase the goods from other supplier. Okay, part D of the question says, give 3 examples of expenses you would expect to find under indirect factory expenses. Do not use the expenses already given in the question. Okay, indirect factory expenses. Okay, give 3 examples. So indirect factory expenses are expenses that cannot be easily identified with one unit of the product. Okay, which you have to compile, and then after that you will do an overhead allocation, then you find an overhead absorption rate, and then after that you allocate to the product. Okay, to each unit of the product. So example of indirect factory expenses will be heating and lighting. It can be factory rental, factory property tax. Yeah, indirect factory expenses. So I say repairs to factory building. So what other things can you think of? Power for machines, machines in factory, lubricant for factory machinery, expenses for canteen run exclusively for factory workers. So whatever you can think of, just put here. Okay, part E, explain briefly the basis of valuing work in progress for inclusion in the final accounts. This question part E may not be very clear. So I try to be more comprehensive and lengthy in my answer, because explain briefly the basis of valuing work in progress. I don't understand whether the question is asking whether explain briefly the reason for valuing work in progress, or explain briefly the base that you are using for valuing work in progress. So I in the answer I include both anyway. So work in progress is a subcategory of stock, you know, here. So it should be valued at the lower of historical cost or net realizable value for each of its individual component which made up of work in progress. You see, in chapter 7 of accounting lesson 1, this one explain about stock. The definition of the cost of the stock, the cost of the stock. So you see, work in progress also is a type of stock. So stock is the actual price incurred on the purchase of the stock, plus any amount directly incurred in bringing the stock to its present location and condition. For example, transport on purchases, insurance and wages on purchases. So this definition actually tells us the cost of the stock should include any modification and repair costs, and any cost, any transport costs for the stock. Okay, to bring to where it is, to its to bring to where the stock is at the end, at the financial reporting date, which is the year end date. Okay, it should include any cost that bring it to the present location and condition. So that means it should include any modification cost. Okay, so that's why I am putting the explanation, incorporating the explanation into here. So it should be valued at the lower of cost or net realizable value for each of its individual component, which make up a work in progress, which include all cost of purchase, cost of conversion. Cost of conversion means like modification cost, and other costs in bringing the work in progress to its present location and condition at the end of the year. So, and then you see the question I'm puzzling whether they're asking whether ask us to explain the base of valuing work in progress or the reason. So I'm explaining the reason. The reason for valuing work in progress is to account for all relevant costs incurred for work partially completed as an asset. So I'm giving a more lengthy and comprehensive answer to cover this question. Okay, thanks for watching.